Okay. So let's just do an introduction to the derivatives. Okay. So the derivatives are based on the price movements of those asset classes, or the price movements of the underlying securities. So I can buy derivatives, puts and calls, on the exchange-traded fund shares and the stocks. I can buy derivatives, the options on the futures contracts, the forward contracts, on the indices that are basically mathematical calculations that track the prices of those 5 asset classes. Okay? So derivatives are basically based on some underlying asset. Okay? Forwards and futures contracts. Okay? For forwards and futures, you are going to buy them when you think the price is going to go up. You are going to write them when you think the prices are going to go down. Okay? The option contracts, you are going to buy the call options and write the put options when you think the prices are going to go up. You are going to write the call options and buy the put options when you think the prices are going to go down. It's basically a decision matrix. Okay? That's all it is. So forward contracts and futures contracts basically state that I think prices are going to go up. Okay? And I'm going to bet that prices are going to go up. So I may be a speculator or a trader, and I did my economic research, and I forecasted that I think the stock market, bond prices, gold, oil, the dollar, whatever, is going to go up over a period of time. And the forward contract is basically states that I'm going to enter a contract, and I'm going to be able to buy that security or that asset, let's say for $50, and if it goes to 100, I'm going to make the difference between the two. I'm going to make a profit. So I've entered a contract to buy, let's say, oil or some share at $50, but it goes to 100. So I'm going to make the difference between the two. So I made $50. Okay. In the forward contracts are very long contracts. Okay. They're long dated, which means that they usually last 1, 2, 3, maybe 5 years. They are between 2 counterparties. So it's basically a contract that's written up by a securities attorney between Deutsche Bank and Chevron, or Chevron and some other company. There's 2 counterparties. One thinks the prices are going to go up. The other thinks the prices are going to go down. I'm going to buy the forward contract if I think it's going to go up. I'm going to write the contract if I think it's going to go down. I'm going to buy the contract if I think it's going to go up. And there's somebody else that's going to write the contract, and I'm going to buy that contract because they think it's going to go down and I think it's going to go up. So there's counterparties. There's no exchange between the two. They're contracts. They're private contracts. These contracts actually trade in what is called the over-the-counter market, or the OTC, which is opaque. You can't see it. We don't know about it because it's a private contract between 2 counterparties. The contract settles at the end of the period. So if it's a 2-year contract, the price could go up and down, doesn't matter over the 2 years, but at the end of the 2 years, boom, if I'm in the money, great. If I'm out of the money, I'm screwed. Okay? So it happens at the end. It's a private market, it's long dated, it settles at the end. Okay? They're negotiated contracts, and they're usually between very large financial institutions and multinational corporations. So the contract, the notional value of the contracts are very large. We're talking multi-million-dollar contracts. Okay? As opposed to futures contracts, not everybody can access the forward market. You have to be an institutional player to do that. Very large multinational or money center bank to be able to trade in this market. Futures contracts solve for that because they're small denominations, small notional values. The contracts are standardized, and they're traded on an exchange, and basically the exchange takes on the counterparty risk and facilitates the writing and buying of these contracts, not by large multinational money center banks, but by regional banks and probably mid-size corporations. that want to be able to use these tools and these instruments to gain access and exposure to markets, but also to be able to hedge, okay? Hedge their position. And I'll go back and talk about that in a second. So the contracts are exchange-based. Most of them trade on what is called the Chicago Mercantile Exchange and the Chicago Board of Trade, although there are commodity exchanges and futures and options exchanges in London and Hong Kong, and they're dispersed across the world. So again, you can trade these things 24 hours. They're standardized contracts, they have small notional values, but the market is highly liquid, and those securities are highly marketable, okay? So very different from the forward markets. In the futures contracts, you can buy forward-dated contracts, but here's the catch. As the market price, right, the market price of either the index or the futures contract is going to be highly volatile around some kind of index. And when the index and the contract settle at the end of the day, you're either going to be in the money or out of the money. And you have to settle that day. So at the end of the day, bam, if you're in the money, money goes into my account. If I'm out of the money, money goes out of my account. So you have to be really experienced, and you got to have some capital in there and to have some credit and some wealth behind you, because if you get hit by a series of losses, you're going to get totally taken out. Okay. What's interesting about the futures contracts is that, let's say you take a position, a forward position on where you think the price is going to go in the future, but all of a sudden it's going down, so you're incurring all of these losses. What you do is you just take out an opposite position and it closes out the position. So if all of a sudden I am writing these futures contracts, because I think the prices are going to go down, but all of a sudden the prices are going up, and I'm losing money, what I do is I buy the contracts, offset the position, and I close out the position. So that's how the futures contracts are actually done. So people will take a position, either a long position or a short position, and if the trade goes against them, they'll take the opposite position, close out the position before they get slaughtered and wiped out. Okay? Everybody follow so far? Okay.
Why do they do that?
To mitigate the losses. Because they're starting to incur losses, either they went long or short, the trades are going against them, they take the opposite position that they take, they close out the position to mitigate the losses. Okay, and the markets are highly liquid, and the securities are highly marketable. There's a lot of broker dealers, they're traded on an exchange, so it's really easy for them to do that.
I was just going to ask, is that the future kind of alongside with like penny stocks?
No, penny stocks are traded on the stock exchanges, and penny stocks are on the pink sheets, which means that they're not listed on the exchange, okay? Because maybe the stock price fell below a certain standard, and they got kicked off the exchange, basically, okay? Any other questions on that? Okay, so now let's do the option contracts, okay, the puts and the calls. So this is the diagram here. Here's your put option. We think the price is going to go down, so we're going to make money. Here's the call option. We think the price is going to go up, and if it goes up, we're going to make money. But here's the problem. If I buy a put option, because I think the prices are going to go down and I can make money by the prices going down, I got to pay a premium for that trade. Okay, so it's going to cost me some upfront money. If I think that stock prices are going to go up, I'm going to buy a call option, but I got to pay a premium. Okay, so the stock price for a put has to drop by a certain amount until I reach a break even, because I got to get my money back. And then if it continues to keep dropping, I'm going to be in the money, I'm profiting. Same thing with the call option. I'm betting that the prices are going to go up. I got to pay a premium to buy this contract. I got to make my money back on the premium amount that I paid. And once I get past the break even, I'm in the money. Okay. Go ahead.
Do you have a bigger opportunity to make more money once you get past that premium?
It depends on the option. depends on how long the option is in force, because and I'll get into the contract values, and really the volatility of the underlying stock are really the two determinants. One is time value, and then the other is price volatility. That determines the premium. So if all of a sudden people think that the stock market is going to go down, they're going to be scrambling to buy put options, right? Because they can make money when the prices go down. Well, what happens is as the demand for puts increases, the premium increases. So you got to be able to get in early, right? At some point, even though you think that the market's going to go down, and you know that you can make money on a put, the premiums are so large that you can't do the trade. It's financially infeasible. Okay. Did you have a question?
Yeah. So the more it goes down, the more you make if you're
Buying a put.
Option.
That's correct.
And so, where does the more you make come from? Somebody who bought a call option?
Well, the call options theoretically, prices can go to infinity, right? Stock prices can only go to 0. So there's a downside limit on the puts.
Okay.
You can't go negative on the stock price.
So if you go the opposite direction, you have a call option and it just keeps going up and keeps going up.
Yeah, you have 3 months. You buy the call option, you pay the premium. The option lasts for 3 months because the time periods in which you can buy the options are between January and March, that's the first quarter, between April and June, the second, July and September, and October and December. So you can buy at any time, between these periods. But right now, I can only buy January to March options. After March is over, April 1st hits, I can buy this April to June option. If I buy in January, April, July, or October, the premiums are going to be higher because there's more time value, right? There's a whole 3 months, okay, that the stock could be volatile and could get in the money.
Yeah.
Okay, so it's more valuable, right? As the time period gets shorter, the option value and the premium starts to drop because the probability that the prices will move enough to be in the money in any one direction starts to shrink.
So I'm just curious, if you buy a call option, and let's just say some company for some reason just shoots up a ridiculous amount, do you make the difference on that ridiculous amount?
Yes, you're gonna buy the call option, all right? So right off the bat you lost money. But if the stock price moves up, you actually have entered a contract that has an exercise price of $50.
Yeah.
And if the stock price goes to 100,
You made 50.
yeah, you can exercise the option. You made $50, but the premium cost you $10, so you netted $35 in profit. And the option contracts are in 100 shares per contract. So if you bought 3 shares, you would have been controlling 300 shares times the $35 would have been your profit. Okay, but you paid the premiums too.
But I'm just trying to figure out if it went, say, to 200.
Yeah, if it's within this time period and it goes through the roof and you entered the contract, your upside is unlimited. But if you're out of the money and the option doesn't work and you've lost money and you run out of time, then the option expires worthless. And the person who wrote it gets to keep the money. So you only have 3 months to do it, or less.
Keep the.
If I buy a call option because I think prices are going up, somebody wrote a call option, right? So if the stock price never hits 50, I'm not going to exercise it, right? Because it doesn't make sense. I'd be losing money, but I lost the premium. The person who wrote the contract keeps the money.
So the person who writes the contract is taking a big risk.
Yeah, especially the call options, because the stock price could go from 100 to 1,000.
Yeah.
Right? They got slaughtered. So people who are writing what are called naked call options, when they're writing call options, they could get slaughtered, and a lot of people did get slaughtered. Got totally wiped out. During periods of time when markets were in a bull run, they got slaughtered. So the exchanges imposed capital requirements, experience requirements, They don't allow a lot of people to write call options. There's a lot more restrictions.
Because it's so risky.
Because it's so risky. Well, writing the put options are, stock prices can't go below 0. So there's a limit, right, to writing the put options. Or sorry, buying the put options.
Yeah, I'm just not really seeing the desire to want to write one of those with the risk outweighing the reward.
No, and a lot of people don't. But these are just basically the mechanics.
So let's say you buy a call option and then the value of the stock exceeds the premium. So
Yeah,
they
exceeds
still keep the premium, right? You just have to pay.
No. Well, yeah, they're going to keep the premium,
Yeah, but
but you're going to be in the money, and they're
Yeah.
going to have to pay you the difference.
oh, okay.
You gave them money up front, but then they're going to have to give you the money at the end because you went against their bet. They were wrong. You were right.
Okay.
Okay. You guys get the option stuff? I'm giving you like chapter 20 right off the bat, basically.
You can buy at any time though, in between those, so.
You can
for
buy,
example,
you can
the
buy
end
and
of it-
exercise the option contracts anytime between these time windows.
Just because like in October, right, the end of the fiscal year or whatever it is, and Janet Yellen comes out October 31st and says, this is what we think.
Yeah, that could have a major impact on if you're in or out of the money, depending
So
on.
wouldn't you just wait till October 31st?
You could if you wanted to. You could buy
And the
it.
premiums would probably go up.
You could buy it any time during this time period. But again, as the time period, a lot of people, what they do is they will wait to an optimal time period within this period to buy the options because there's not a lot of time left. And a lot of the time value has gone away, and the options are cheaper. But you're gonna have to have more price movements. So there's a timing strategy in here too. Okay? Any other questions on the options, and the futures and the forwards?
Real quick,
Go
you
ahead.
can, if you do that, you can sell it at any time
You
throughout
can-
that contract
You
period,
can
right?
exercise the option at any time during this time period. That is called an American option, okay? In Europe, they have option contracts that are called European options, but they only exercise at the end of the period. There's no optionality. There's no option to exercise during this time period. That's why the premiums in the United States on our options are higher, because we give the investors the opportunity to exercise the option at any time period during that 3-month quarter, during that 3-month period, okay? So European options are a lot like forward contracts, because they settle at the end of the period. In the US, you can exercise it at any time you want during the 3-month period. Futures contracts, you can settle at any time. Forward contracts, you cannot settle at any time, you have to settle at the end of the contract period. Okay,
That's,
go ahead.
for the forwards contracts, is there other markets that you could sell before it expires?
You could go to the investment bank and say, I want to sell my forward contract, okay? And they will try to find somebody who will buy that contract for you, and you'll probably have to take a discount or a haircut, because it's an illiquid private market, and not everybody wants to buy, a customized contract between two counterparties.
Well, can you buy futures or forwards on like barrels of oil?
Yes, you can. Yeah, that's, the futures and the forward contracts are based off of the oil price indexes. It's based off an index, okay? And Standard & Poor's is basically the company that basically creates the majority of the indexes for trading these types of derivative contracts. I worked for them. They were my partners. When I was at Schwab, my team built a series of real estate price indexes, and we were developing the derivative markets based on our indexes. Okay, so if you ever want to go through that lecture and show how to construct indexes and how to develop a real estate capital market in property derivatives, basically using exactly the same contracts with the same finance theory, I'd be willing to walk you through that if you're interested. 'Cause it's basically a culmination of my whole, 25 years of academics and profession. Any other